Founder and CEO of Tusk Ventures. He was an early investor in the company, though no longer is in the name. And Bradley, obviously the food business is on fire here with Uber Eats. It looks like bookings came in better for ride sharing as well, but revenue fell because of this adjustment they had to make because of a UK dispute over driver reclassification, which is a sharp reminder to investors that this is a very much a live issue, even here in the U.S.
Yeah, it is and it isn't. So nationally, in order for D.C. to actually go ahead and reclassify workers, Congress is going to have to pass a law doing so, and the president will have to sign it. I think with a 4-seat majority in the House and a 0-seat majority in the Senate, hard to see that getting through. But this has been an issue that different states have moved forward. California did until the voters overturned it and rejected it. Other states are looking at it as well. So it's still a live issue, but really much more of a state issue than federal, and a global issue too. And it's definitely something that Uber investors and Lyft investors have to at least be aware of.
So, Bradley, how do you think it enters into the debate around Uber's stock and profitability, which it did come much closer to?
Yeah, so look, I think realistically speaking, we're not going to see full classification of all drivers as full-time employees anytime soon, which means if you were looking at the stock, unless you're looking at it from a very, very long-term basis, I think that you should not worry too much about the impact of that. So if you like where ride sharing is headed, if you like overall what Uber's doing around Uber Eats and GoPuff and Drizzly and everything else, then it's probably a good investment to make.
Bradley, I mean, looking at Uber now trading lower after hours is interesting, given that that's kind of been the theme of this earnings season for big cap tech stocks. Some blowout reports, and a week on or a day on, they're all trading lower. What do you make of that?
Yeah, I think partly it's a variation of the same problem that we faced when WeWork or Uber tried going public in the first place, which is the private markets, of which as venture capitalists, I'm involved in too, are often setting valuations of private companies at numbers that are just way too high. And so by the time these companies go public, there's just not that much more room for growth in the share price. And also, when a tech startup goes public after a couple of years, it still has that magic and hope and excitement around it. If you've been private for 10 years or longer and you finally go public, all the pixie dust is gone. And so a lot of the pop that normally comes with tech IPOs just isn't there.
Bradley, stay with us if you would, because we do have more on Uber from our Deirdre Bosa. Deirdre.
Yeah, I've been listening to the call, and shares turned negative after comments from CFO Nelson Chai on guidance in Q2 and the rest of the year. He said that the mobility take rate is expected to decline about 20% in Q2 due to more driver incentives. Remember that Uber has already earmarked $250 million in what it calls driver stimulus. He also said that delivery gross bookings year-over-year comparisons will become tougher as we continue to face significant forecasting uncertainty. So that's the delivery side of the business that some investors have been worried about. These tougher comps, people going out more. We didn't see that effect in the first quarter, but the company basically saying to watch out for it. We could see it in the rest of the year, and certainly different from what we heard from Lyft yesterday, which doesn't have that business, but also didn't really talk about spending a ton more on driver incentives to get that supply back up.
Really interesting, Deirdre. Thank you. Uber now down 3.4% after hours. Bradley, that's the theme of earnings season, figuring out the tough comps, right? Figuring out who's going to have to face the music when it comes to the pandemic benefit that they've seen, especially in your world of tech. How are you thinking about the winners and losers where you're investing privately and publicly?
Right. It's a great question. And the way that we're looking at it is, where did behavior change in ways where that change is now locked in? So take, for example, the mental health space. We're investors in a company called Alma. Their business has boomed since COVID. Not shockingly, people now are getting their mental health services on their phone or online in some way. I don't think people are going back. I think most people feel like they get what they need from a phone call or some sort of online visit. And to have to take the time to go there and get back and everything else, that goes away. On the other hand, food delivery, and we don't have any food delivery investments, but some of that seems like it's going to have to go down because you replaced all of people eating at restaurants with people ordering in. Some of that is going to filter back to the other side. So it's really where are the behavioral changes that it just makes sense for people to keep acting this way. Business travel. There are certainly things that I got on a plane for in the past that I would not get on a plane for now. couldn't do it during COVID, and now that I'm vaccinated, even could. Zoom works pretty well in most cases. So it's really the belief that you have on whether the norms have shifted permanently or whether they're just temporary because of the pandemic.
Shepard Smith here. Thanks for watching CNBC on YouTube.